Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Toews, CEO of Toews Corp, an asset manager that focuses on behavioral portfolio design to discuss putting money to work in hedged funds. Phil, it's great to see you again. Welcome back to Trade Talks.
Thanks very much, Jill. Great to be here.
And Phil, explain to the audience what hedged equity funds are.
Well, hedged equity funds are trying to accomplish the relatively simple concept of being invested in the stock market, but attempting to address the contingency of falling markets. And so one way we think of to look at it is, right now everyone's asking the question, with markets overvalued as they are, do you stay invested or do you leave the markets? And what hedged equity funds are attempting to do is allow you to not have to answer the question, because if you have something that can potentially lessen losses as things fall, then that addresses the potential of the falling market.
So then how would they fit into an investor portfolio? You have your existing portfolio and this complements it?
Yeah, so one of our divisions at our company is a behavioral investing institute. And what we think investors should try to do is to try to build portfolios that will navigate really any kind of a market. And that includes really extreme markets like what we saw in the Great Depression or even the Japanese stock market. And so the portfolio that we've put forth, something we call a behavioral portfolio, has 50% of stocks invested in just low cost beta, something that's going to move up and down with the market, but then has fully 50% of a stock portfolio into something like a hedged equity strategy or a hedged equity fund that can address the possibility of falling markets.
And what should investors do who are looking for hedged equity or long short funds? What should they be looking for?
So a couple of things. First of all, you want to find something that has pretty much full exposure to the stock market. The more that gets weighted down, then the less participation you're going to have as it moves higher. But a key thing we think investors and advisors should look for is, what is the down market correlation? In other words, how much is it going to move down, or has it historically moved down when the markets fall as well? And so you can find a lot of funds that have moved down as much as 2/3 of market losses, to other funds that pretty much bolster and can leave markets entirely. So look for high up capture, and the lower up capture, the better as well.
And Phil, how did the Toews hedged US funds perform through the pandemic and the recent bouts of volatility that we've seen?
So, last year is a great year to look and see how strategies fared. One of the things that was somewhat unique about last year, as well as in the fourth quarter of 2018, is just how fast markets fell. And there's one key differentiator, we think, between a number of our hedged equity strategies and other hedged equity funds or buffered ETFs, is that many of our strategies can leave the market entirely. And that's exactly what we did last year. So in late February, a number of our hedged equity strategies moved entirely, first into investment grade fixed income, and then later into cash equivalents. And they stayed out. So during the worst days of the market, we were more or less just moving sideways while markets were cascading lower by as much as 5% a day. But the other thing that happened, though, as markets rebounded, those same strategies re-entered the markets in April. And for a majority of the rest of the year, were pretty much fully invested. And so what that shows then is that you want to be able to do both things. You want to try to have some meaningful loss avoidance if you can during falling markets, but then get some real traction if possible during rising markets as well.
All right, Phil, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.
Okay, thanks, Jill.